All right, many investors are becoming interested in Opendoor technology stock as the price is extremely volatile, soaring over 100% one day before falling back down by 50%. And this price action attracts a lot of investors. And I've seen a discussion about this stock on messaging forums, and it's creating that kind of enthusiasm that once existed back in 2020 and 2021 for the meme stocks AMC and GameStop. So I understand the interest in these kinds of companies, and I wanted to provide information to those of you that are interested in this stock. So at the very least, you have some information to make a decision about and not just go off of the hype and enthusiasm surrounding this investment. So I'm going to share with you some details. At the very least, you should know about Opendoor stock.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Right. So in its latest quarter, the management team said that they delivered $1.2 billion in revenue, which was in line with the same quarter of 2024, meaning the business is not growing. That represented 2,946 homes sold. On the acquisition side, they purchased 3,609 homes in the first quarter, which is up from 4% in the same quarter last year. And in this statement, investors also get some insight into what the company does. They buy homes from homeowners, they give you a cash offer to buy your home, and then they flip the home and try and sell it at a margin, at a profit. That's what they're in business of doing. So in that business, this is what occurred in terms of the number of homes sold and the number of homes purchased. So as you can see, they purchased significantly more homes than they sold, which means their inventory of homes increased. Now, this is coming at a time when home values are starting to stagnate in the United States after rapid increases during the pandemic when prices absolutely soared from 2020 to 2022. Home price appreciation has slowed down and is even turning negative in many cities and states in the United States. So, given these headwinds, the company is focusing on profitability. They cut their marketing expenses significantly, and they even created a wider margin of safety in their business model. So, previously, maybe they were more competitive in the prices they offered homeowners. And given the recent headwinds in the real estate market, they've kind of reduced the prices they offer homeowners, and especially relatively speaking. So if they think they're going to be able to sell a house at a certain price, they're going to give a bid that they're going to buy it from you that's going to be significantly lower than where they think they can sell that home for, so that they can guarantee themselves a nice healthy profit margin. And of course, that's going to result in homeowners declining a lot of the offers because the offers are not going to be competitive enough to entice homeowners to sell those homes. But Opendoor is okay with that. They would rather have that situation rather than overpay for homes and then have a bunch of homes on their inventory where they can't resell them at a higher price. Remember, I know a lot of investors are making the connection between Opendoor and Carvana, and they are similar business models. Carvana with cars, Opendoor with homes. Carvana purchases cars from consumers and offers them a price to purchase their cars, and then they try to resell them at a higher price. And remember how much trouble Carvana got into with its inventory? Remember, used car prices soared during the pandemic as well, and Carvana was buying so much of that inventory, and then they had all of this inventory at these very high values that they paid for, and they weren't able to resell them at those higher values when supply chain disruptions eased and people were able to buy new cars at normal levels, not the levels during the pandemic, which had significant supply chain problems. So Carvana got stuck with all of that inventory. They had to sell at lower prices, creating all of these losses and cash flow problems. And so Opendoor doesn't want to face that same situation. They're learning from what Carvana went through. I don't know if the management team is specifically focusing on what happened with Carvana, but I think it would be a good case study for the management team to look at what happened with Carvana and avoid that situation, avoid the situation that led to that big downside with Carvana. And they are doing that. They are creating that wider disparity between the price they think they can sell the homes for and the price that they're bidding to homeowners so that they can buy the homes. They also cut down significantly on their marketing spending to create lower fixed operating expenses. Uh, and that's leading to a outlook where they are forecasting profitability on an adjusted EBITDA basis. In the first quarter, their adjusted EBITDA loss was 30 million. That was down from a loss of 50 million in the same quarter last year. So if you divide that improvement, they improved by 20 million. 20 million divided by 50 million, they made a 40% improvement on their losses on adjusted EBITDA. And looking ahead, the management team is forecasting they will generate profitability on an adjusted EBITDA basis in the second quarter. So they also told us that they ended the quarter with 7,080 homes, representing $2.4 billion in net inventory value, and that was up by 24% from the same time last year. So that's a bit unfortunate because as the real estate industry is going through this difficult situation, you don't want to have more inventory. This isn't the type of market scenario where you want to have more inventory. So I think that strategy coupled with their inventory was a good decision to make because they already have inventory that's much higher than where it was last year. Their sales are not increasing. The market is not improving. It's actually going in the opposite direction. So you don't want to be building up inventory at this time. And so I think it's a prudent strategy from management to slow down the buildup of inventory. So you don't want to spend so much on marketing because you don't want too many new customers coming in. You're not interested in building up inventory right now. Also, you're widening the spread. So you're offering lower prices to new customers that are coming in. So the only way you're building inventory right now is if you're getting these new homes in the current quarter at lower prices, at a price that you're very, very confident you'll be able to sell to somebody else at a higher price, so generate a profit. So this document I'm looking at is Opendoor's first quarter 2025 earnings call transcript. This highlighted document I've made available to my channel members, and I have over a dozen companies, and I'm adding to this weekly multiple new companies. It's one of my newer membership features. I have so many more features. There's a link in the description where you can learn more about the membership program at our channel. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.